Before we get into today's episode, I just want to remind everyone, SBA Today is now available on podcast streaming services. Catch up on all the latest news in the world of SBA with our beloved co-hosts Tanya Mazurik and Paul Long. I love the show because I always learn a valuable lesson listening to their real-life stories, and the way they deliver it and tie it back to what we do makes the show really entertaining and really fun to watch. Critics are calling it Regis and Kelly meets SBA Connect. Check it out today, and don't forget to subscribe to SBA Today. Today, we're diving into a topic that we've all been thinking about, raising the limit on the SBA 7A loan program above $5 million. Our guest today is leading the charge on trying to increase that limit to $10 million. Steve Miriani joins us. He is the founder of Diamond Financial, a well-known name in the SBA M&A space, serving as a financing intermediary. And he sits down to share more about his latest mission, as well as the overall state of SBA M&A lending, and how he built a niche in the business broker community. One more thing, Steve is circulating a petition to show the SBA how much support is behind this. He's up to almost 1,000 signatures. I signed it, and I would encourage you to do the same. I'll leave a link in the show notes. Now on with the show. If you're an SBA BDO, you're probably getting multiple calls every week from recruiters telling you about an amazing opportunity at an incredible shop with an open credit box and a strong comp plan. You got to at least hear them out, right? The truth is, most good BDOs can't move because they'd be leaving too much on the table for it to make sense. But alas, all good things must come to an end. When that time comes, how do you decide that critical next step? You need to talk to an industry insider who knows the market inside and out, an advisor that can cut through all the BS and tell you what it's really like to be a BDO at this bank or at that bank. Baker Lewis has 30 years experience, not just in recruiting, but in every aspect of SBA lending. They know the business and they are committed to helping people make the right move, even if that means they don't get a placement fee. If the time has come for you to consider a move, I'd encourage you to partner with an advocate like Baker Lewis, who will help you evaluate the market the way they would if they were making the move. An agent who can help you get the deal you didn't think was possible. Let me tell you folks, anything is possible. Call Baker Lewis. All right, well, thank you so much for joining us today. So first of all, what caught my eye was your interview with Jim Parker on raising the SBA minimum cap. And that's something we've been kind of talking about, not in public, but for a while now, because ever since inflation obviously made everything more expensive, we're like, why is the cap still 5 million? But you actually went and talked about it in public. Not that it's like controversial or anything. It's actually pretty common sense, but it caught my eye. And that's why I wanted to have you on the podcast to try to unpack that a little bit more and learn about what you're doing, with that new mission of yours there. But before we get started, can you just kind of, for people that don't know, what's your role in the SBA lending process?
Sure, I'm happy to expand on that. Our company's been around almost 30 years now, and we work with the majority of the top level lenders in the country. We handle a lot of larger goodwill transactions. We're typically on the creative side when we're going over 5 million, which is one of the reasons I've really implemented this. We have 4 transactions right now between 6 and 10 million, and it's a piecemeal. That's really what's driven us to find a better method. And once we drill down on the facts, it was a no-brainer. The SBA has been long behind everything else here.
So what is the history with regards to like the size and the caps of the 7A program?
Sure. It was $2 million until 2010, when it went from 2 million up to the 5 million current cap. And actually, if you drill down on just the cost of living increases over the last 14 years, that 5 million today buys you 42% less than it did in 2010. And that is not accounting for any of the latest inflation and all the latest double-digit increases we've seen across the board on so many different products and just mortgages and interest rates and everything else. So, that's what's really driven us. So the majority of our clients are not looking for a $4 or $5 million business anymore. They're looking for a $7, $8, $9 million business. And that's because it buys what it used to buy back in 2010 now. So that's really the big crutch.
Well, that makes a lot of sense. I know, like I said earlier, like we all agree. Everyone is like, yeah, like this program should go up in size based on all of these different factors. But what actually made you take that next step to really go out and start this sort of movement? I'll call it.
Happy to answer that, Ray. Really, back in October when they made all those additional changes in the SBA world, the partial buyout and things like that. Well, this was a rule that was kind of added on at the end and really slipped through the cracks of most lenders. And now that the dust has settled and all those other rules have taken their effects and we all understand them, and partial buyout and the down payments and just everything. Well, now lenders or actually brokers are drilling down on this last rule, which is the lack of affiliation rule.
Right.
It is currently on the books where we can write multiple $5 million loans for the same borrower. And really the difference and what I'm trying to change is they allow that to happen if the borrower buys in an unrelated industry. Well, that's really what was brought to my attention by some of the top brokers in the country. Why would we allow them to buy in an unrelated industry and not in their own industry? And this rule doesn't even allow for just a second $5 million loan. It allows for multiple $5 million loans. You could write 2, 3, 4, 5 loans at $5 million for the same borrower, as long as he's not in the same industry that his resume fits into, which makes absolutely no sense to me. So once I actually read into it, the first thing I did, Ray, was contact the SBA to confirm, hey, this is our understanding. That is after I spoke to a few of my top lenders. Because they all, like I said before, we were realizing and understanding this rule late in the game. It just came down in the last 2 months or so when we were really drilling down on this particular rule. So I polled my lenders. They all came up with the same interpretation that, yes, you can write multiple loans to the same borrower. So I went to SBA just to confirm before I got on this soapbox. And sure enough, they came back with a positive response as well. They said, yes, you can do this in unrelated industries. Well, that just made absolutely no sense to me, especially as we're handling and trying to creatively structure 4 different transactions that our firm has between 5 and 10 million. We're closing a 7.3 or I think 7.3 today. But as you may know, that takes a lot of creativity. There's some seller financing, there's a 504 loan, there's a 7A loan, there's a CDC involved, there's a first conventional loan. And as I'm working through the process on multiple loans in our establishment, I'm thinking this is just ridiculous when I could write a second loan for the guy if he was just buying in a different industry. So I really think that that's what drove us to just logically make sense. Let's just fix this one statement that allows them to not go into a different industry.
Even some people are probably hearing this right now and that's news to them, because you're right. It kind of flew under the radar with those changes with regards to what the lack of affiliation now can do. I put out a YouTube video in, I think, October of last year, breaking down the new rules. And this is one where it was like a bonus point I mentioned in the video about like, hey, this is what it says. I haven't done this in practice yet, so I want to be a little cautious here, because like that's an absolute game changer. It's just so different than what we've been dealing with for so many years with regards to the 5 million cap being tied to you personally. So since then, you've confirmed it. I've seen people actually close deals where people go above the 5 million cap. I've seen the SBA confirm it myself. So this is the new world we're living in. So your point is, why wouldn't we just, because it's a job creation program at its heart, right? So if we can lend more money to an existing business owner and create more jobs, why wouldn't we?
Absolutely. You just hit the nail on the head. Not only do we create more jobs, but we also create a bigger bucket for the SBA, because I know their motivation right now is lower and underserved communities with the fintechs and the algorithm type transactions and things like that on the smaller side, which is their motivation. Well, they're going to need the funding from someplace, especially now that SBA has waived the fees on $1 million and below loans. So I keep thinking, this upside between 5 and 10 million can only help. It can only help the program. It can only help the local communities to fund more of those small business startups. It can only help the underwriters and lenders, because guess what you're going to do if you're running an $8 million transaction? You're going to put that under a bigger microscope, And let's face it, when we really drill down on the defaults, it's not on the larger transactions. I see that the drop off, once you get to those kind of levels of loans, the default just falls off. And I've pulled many lenders on this as well, and they're on board with the same thinking, that the defaults are so much lower when you're talking to an executive that's putting down $1 million or $1.5 million on a $6, $7, $8 million transaction. So, there's the other upside, which is why I go back to, I could not find a downside. And that's really what I pulled the country looking for. Someone shoot holes in this. And I just haven't found any negative feedback at all.
Yeah, no, you're right. The SBA, would get more revenue from this. That's a good point. Also, there just seems to be a little bit of gap in the M&A market between SBA and what the $5 million, cap, and where middle market sort of M&A lenders will step in and start lending. And that's kind of birthed this sort of pari passu market, which is where a handful of lenders will, participate in, basically, to try to bridge that gap. But it's showing you that the need is there. And at the end of the day, if SBA cares about access to capital and there's a gap in access to capital and lenders are having to scrape and claw to kind of put it together, it kind of shows you that there's a need there, right?
You just sit down and have between that 6 and 12, 13 million, there's no lending, and that's why I wound up in those transactions. And a lot of my friends wind up in those transactions, getting creative. We're trying to piecemeal a transaction where it shouldn't be this difficult. If the SBA does want to help small business and create jobs and generate money for, like I said before, those smaller community programs, this is the avenue. I'm opening the door for them to. The fees will be a lot higher. They have a lower default rate. This is just all positive. Not to mention exactly what you just said. We're creating jobs in the local communities. We're putting people to work. If a company has 10, 12, 15 employees and they can double and add another 10, 12, 15 employees, why would we prevent them from doing that? They're established operators already with a track record, a resume in the industry. These are the people we need to be supporting. These are the ones who drive the country and employ the 44% of Americans that are employed by small business.
Well, I still can't think of a downside, but I can keep thinking of more new upsides for you to kind of, use. And one of them is, you mentioned you're doing a 504 right now in conjunction with a 7A on an acquisition deal. And, a 504, the SBA is guaranteeing 100% of that debenture piece, which is $5 million, right? So that alone, if that $5 million was tied to a 7A with a 75% guarantee, that would give you a $7 million right there as a loan. And, a 504, you can finance large projects. it's, a $12 million project's no problem for a 504, just because the debenture piece is being paired with a conventional. So you're in this sort of market of doing these $10 million deals on the 504 side. And the 504 is simply giving business owners a place to house their business. The 7A is, a growth vehicle. It's an acquisition vehicle, and it makes no sense why the 7A would be capped at 5 million when they have a sister program that's able to tackle multiple projects. And if they slap some solar panels on the roof, go up to 5.5 million and do multiple, right?
I totally agree. That's exactly it. Why would you not help the flagship program? So many, and even the transactions I'm working on today would be better served in a single 7A. As you know, the conventional and the 504 piece are both painful on the building and real estate side. But, again, the 504 is fully collateralized transactions, which, I'm happy to put all the assets in there, but the cash flow is really driving up the goodwill numbers these days.
Okay, so we all agree. Now, what's it going to take to get this done?
That's where we're going. So what we're doing right now, we have the petition out there. I don't know if you've been aware of it or made your listeners aware. There was an iPetitions out there that I'm circulating. We have over 700 signatures on as well already. We have, which is more important, and what I brought up to my contact that's going to be meeting with the SBA, there's over 220 comments. Out of all the people that have read the petition, read my emails, read my information, and have signed it. Over 220 of them sat down and actually wrote comments. And I looked through almost every single one of them as, again, looking for people to shoot holes in it. And there was no downside. I mean, every single comment was on the positive. I printed them out just to make sure I didn't miss any. But this is really what our industry needs. It needs to catch up. I'd love to even take this one step further and put some kind of automatic raise in it if I could. But I'm not rewriting the SOP. What I care about today is getting this through. But there should be something that accounts for inflation and cost of goods increases. Cost of living increases in the future years. I mean, it's incredible that I look back 14 years and realize how far behind we were.
Well, I signed the petition today, and we'll leave a link to the petition in the show notes of this episode. The SBA landscape is changing right before our eyes, and technology is a big driver of that. To think, just a decade ago, I was getting physical loan packages mailed to the office. We've come a long way. But a lot of folks are still getting tripped up on emailing documents back and forth. Files are too big, there's security concerns, and my personal favorite, I already sent you that. Now, I don't have those issues because I use Able. Able is a deal acceleration platform focused on driving efficiency and improving the borrower experience. They plug right into your existing LOS and solves the document chaos between your team and your borrowers. Borrowers get a place where they can collaborate on loan documents at any time, and your team can easily name, organize, and push documents with the click of a button. Welcome to the future. I encourage you to go to able.ai for more information and schedule your demo today. But what do you do with the petition? Once you have a bunch of signatures, is there a certain amount of signatures you need? And what are you going to do with the petition?
I'm going to document all of that down to show when we do step into the SBA arena. These are the people that support it. These are the people that run our country that need the help. So I'm going to go there with all the full count. And again, with the comments. If they want to read the comments, I mean, every single comment just outlines how it's going to help our industry. Some people wrote paragraphs. I mean, it's amazing the amount of feedback. And not only brokers, but lenders and attorneys and CPAs. I mean, everyone is chiming in. This is the small business community of America. So we have to all step up. So the more signatures we can get, and there again, I'm including the NSBA. I'm on the Leadership Council for the National Small Business Administration, and they're going to be also taking this on and assisting us as we go to SBA. I'm talking to one of the previous chairs of the NSBA and have them on board. So that's why we're all putting this together and just going to go directly to the SBA and say, hey, this just makes sense. Why would you not do this? Again, shoot holes in it. There's no reason to not.
Does the SBA have the authority to change it, or will it take an act of Congress?
I don't know that answer. You know, we've seen them write memos on all kinds of things in my 30 years. So I don't know if they can officially do it themselves. I would love for them to at least be on board and bring it to Congress, because I think we can get the support there, no problem, to be honest with you.
It's just one of those things where I think it's Congress, but I could easily be wrong. But I'm pretty sure. But I think it's one of those things where it's like, so everyone agrees. Now it's just like, what do we do? How can we actually do this? And you know, there's a phrase called, it's going to take an act of Congress to kind of make people, you know, it's when you have something obviously that's going to be really hard to do. This is one of those things where it's just like, it's the perception, I think, that we've been sort of spending all these last years hearing SBA laser focus on these small dollar loans. And then for us to get the administration and Congress to focus now on going the exact opposite way to the higher end and to make changes there, even though it makes total sense, it's the PR war that I feel like is going to be the most challenging part.
Well, that's the exact reason I am pushing the benefits to the small business communities, you know, the lower end loans, those startups. I mean, right now, like we mentioned, if there's no SBA fees being collected on those, well, we're going to run out of funds at some point. I mean, that was brought up in front of Congress when these rules came out last year. Many lenders stepped up in front of Congress, and I've watched every one of those hearings saying, this is going to run us out of money, and within 12 months, we'll be broke. Well, here's an avenue where they could be self-generating again, because we've been self-funded since 2001. Well, here's an avenue that can put money into the pot and into the bucket to help those small businesses. So if they're if their mission and it's critical for them to support those low and unserved communities, they're going to have to fund it somehow. This is going to be a great avenue for them. Again, why not?
Yeah, that's a great pitch.
Yeah, our presentation is going to start with those. Hey, this is the benefits to your programs. And then all we have to do is A, B, and C. I mean, like we said 3 times already, there's no downside. The lenders is taking the risk here. They don't default.
Why isn't Nagel taking the lead on this? Like, why is it falling on the shoulders of Steve Miriani? No offense, you have a big voice in the industry, but like, where are they on all this?
I've been asking myself that question for almost a month now. I keep wanting someone to steal this from me and run with it. Someone with deeper pockets and bigger connections and everything else, but no one's doing it, right? I don't know. Is it you? Do you have connections? But I don't need to put my name on this. What I care about is it gets passed and gets done for this industry as a whole. That's the goal.
Right. I always tie it to like, if the mission is job creation, so every dollar that we spend in the program, and it's not even spend, right? Because it's 0 subsidy most years, but for every dollar we lend, let's say, how many jobs are we creating? And so the couple industries scare me a little bit with that calculation. Hotels is one. So I can see us doing an $8 million ground up construction of a hotel. And how many jobs do you create at a just really, 100 room, really nice hotel versus if I gave 8 million to a manufacturing company to grow? I don't know the numbers, but I just think a lot of money going into the real estate and the assets may be less fruitful on the job creation side, as well as SaaS. SaaS businesses are higher multiples and higher prices a lot of the times, and they're known for not having a lot of jobs. And if they do have some jobs, a lot of them are overseas. So that would be the only concerns I can think of, is doing really large deals that don't move the needle on job creation.
And I, like you, I'm not privy to those numbers of the job creation, but all I keep thinking is, at $5 million or above level on any acquisition, it's not going to be a mom and pop organization with family members running it. If we're looking at $6, $7, $8 million transaction, it typically has 20, 30, 40, 100 employees. Again, this isn't just for an acquisition. This could be for an expansion. It could be for either a competitive buyout or just a new building and a level of expansion that they wouldn't have opportunity to now. So it doesn't necessarily have to be through acquisition. It could just be through job creation and machinery, equipment, building, everything else to continue to grow the company that they've grown.
Right. Fair point. Yeah, absolutely. And then also use 5 million to acquire the business and then, have more access to capital to actually grow it. Right. Well, let me ask you this, since you talk to a lot of lenders and you work with a lot of lenders, do you think, these SBA lenders even have an appetite to do a $8, $9, $10 million deal?
Great question. It's something that I told the lenders on back in the beginning, because I also recognize that, well, if we didn't get any lenders on board, well, how would that be helping us? So I actually polled 6 lenders, and 4 of them said we would absolutely entertain it. 2 of them said, it takes, again, act of Congress within their banks to even consider such a thing. But the other 4 said, and this, again, I know that has a credit in top people, so this isn't coming from just a lower down salesperson. But 4 of them said we would absolutely entertain it because those borrowers have been our best performers to date. So those people that they did write $4 and $5 million, so they want to help.
If you look at the data, the larger deals have lower default rates. It's just a matter of banks being afraid of taking a big hit on a $5 million airball deal. Some of these smaller banks that just can't stomach many of those. And so I get that, but the data is important too. And you're going to balance out lower defaults on smaller loans with with lower defaults on larger loans. Now, did I hear you say, the word of a salesperson is not as good as a credit person?
Well, here's where the disconnect sometimes happens. The back office changes policies, updates things, really knows the story and doesn't get it out to their EDOs. I've seen that many times over the years, especially if it's on the tightening up side. they don't share. If it's on the loosening upside, I find they typically share with their salespeople real quickly. But if it's
Yeah.
on the tightening upside, sometimes it takes
That message takes a little
two,
while to
three,
get to you.
6 months, to dribble out. So,
Well, that's
wow.
funny. No, we kid around, but listen, I want to take a step back here and just because you're really dialed into the M&A market, in our SBA space. Can we just speak broadly on like what does the state of SBA business acquisition look like as we sit here today?
And that's a great question because it's changed. I would say over the last 15, 20 years. When I first got in the industry, almost 30 years ago, everyone was against it. Don't do SBA, you'll never close, do self-financing. Well, and I think this lends itself to exactly our point today. As the business have grown, well, so has the requirement for SBA funding. Now, there are so many broker offices around this country that won't take a listing if it can't secure financing. It's just not worth your time. If you're looking at $1.5 million, $2 million acquisition or possible selling price, without SBA, everyone's going to take a haircut, the seller and the broker and everybody. So SBA has really become more of a main street and more of a mainstay for every transaction that I see happen. There aren't a lot not getting done through SBA unless it's an ineligibility question. Then you know what? Like I said, we have broker offices around the country that will screen their deals with us before even accepting a listing contract. Because if it can't get financed, they don't even want to put it in their listings because it's going to be a waste of time and an overall time suck with borrowers looking at it and things like that. So that's become more and more inbred in the broker communities, in the transaction market these days. It's just a fact of life now. It's got to qualify for SBA financing or else you're going to be piecemealing it together with mostly seller financing again. And who takes a beating there? Typically the broker when it's 100% seller financing transaction.
It's, you're right. That is a really big change. I've been doing this just under 15 years and coming in, it was almost like coming in 2011, timeframe 2012, 2013, tough years looking at, 09, 010, 11 tax returns, and it was almost like 10% of loans were SBA and it's like the reverse now. I mean, it's been a whole complete shift. Do you think so? SBA definitely is it's like hand in hand with the M&A market, but do you think the idea of acquiring a business with an SBA loan just in general, do you think that's gone mainstream, like to the general public? Like, is there more awareness on it out there?
Absolutely. I talk to, like I said, I work with a lot of high net worth individuals looking at those larger goodwill transactions, and the brokers on that side I work with as well. Their listings that say SBA pre-approved or SBA eligible instantly get a lot more attention from my high net worth borrowers. They look for that for a few reasons, not only for the financing aspect, but right away they think, well, there's been an independent third party looking at this transaction and somebody else have a lot of the confidence in those numbers. So that's always a turn on typically for the high net worth borrowers, especially if they're coming from the executive world or anything like that. They have learned real quickly, well, if it's SBA approved, there's somebody else with eyes on this transaction that has seen and or verified some of the numbers. So I do think it is more mainstay on any transaction. Unless we're talking about 35, 85, $125,000 transactions, anything much bigger than that, sellers, if they're retiring, they don't want to hold the paper for 10 up to 25 years. So everyone looks at how can I be cashed out? So brokers, I think, are more trained on, hey, as you get in this industry, you want to make sure these things qualify for financing. Otherwise, you're going to be, a world of hurt when it really push comes to shove. So I do think, and when you talk about the M&A world, a lot of the brokers that we've groomed and worked with for 10 or 15 years are by default slipping into that market. I have one broker right now that said I have a 12, I have a 14, and I have a $17 million transaction. If you got me 10, all three of those, I could make work with $10 million. With $5 million, I can't make any of them work.
Wow.
And this is a broker I've been working with for over 20 years, but by default, that's where his market has gone. And I think a lot of Main Street brokers are in the same boat. They have slowly transitioned into maybe their bread and butter is in M&A, but some of their transactions that happen in the M&A world, that's just how it is these days.
You're like super dialed into the business broker community. How did you build a niche, in that sort of market?
Oh, well, that's easy. What I've learned early on was every lender has a box. And no matter who you're talking to, if it's a direct lender, all they're thinking about is, this is our box. How can we put this transaction into this box? And that's what I learned early on. I actually stood in front of a group, this is probably 10 years ago. And I said this, I said, I think that lenders do it backwards. And the whole group freaked out. And there were probably 6 or 8 lenders in the room that were my friends. And I said, I think the deal needs to be structured correctly, utilizing the SBA rules and all the optional rules and benefits, and then exposed to a lender. I think that when you're talking to a direct lender and they're trying to think about, well, how can we twist this? We need a little less goodwill, so we want to push up more of your collateral, things like that. When none of that has to happen up front, they think of that. And what I said in that room was, if it belongs in Mark's box, I want it to be at Mark's house, or if it belongs in Pete's box. But if it doesn't, and it belongs in one of the other boxes, well, then you're not even exposing it to the other people or understanding how it could be structured better to benefit all the parties. We probably restructure between 80 and 85% of the transactions that come into our shop. And that's because no one is aware of all the optional rules, all the other lender benefits. Everyone thinks, well, it's an SBA lender, so they're all the same. And right, they're not. Everyone has a little bit different flavor, a little bit different box, a little bit different credit criteria. And that's what makes us all perfect. And that's why some transactions belong in box A and some belong in box B. People don't know it. And really what drives me is when I see them get squeezed into the wrong box and have that round pegs, banged into that square hole because they had to find a way to make it work. And, when it could have been structured so much better and so much differently. That's the same thing I'm up against today. And that's my frustration. These $6, $7, $8 million transactions, we're working on a 9.5 right now. I have to make the seller hold almost $3 million. That's ridiculous. It's just, that's where my frustration comes. This could be done so much better.
Well, I'm glad you're leading the charge because you do a good job explaining things, especially like when you're talking to different groups, you kind of have to speak their language. Like if you're talking to business brokers versus borrowers versus lenders. And one of the things I've noticed about your business is your tagline. You put it out there. What is it? Basically, give me 3 days and I'll give you a yes or no with 94% certainty. Just the fact that I even remembered that is like impressive because a lot of people will make their tagline like making dreams come true or something like that, But yours, it seems like it was very intentional the way you did it.
Yeah, I'm happy to expand on that, the way that came from. That actually came after we hired a CEO back in 2016. And as he was digging through all of our information and transactions and all, he said, "Did you know this?" And I said, "No, I didn't." He said, "Now, this has always been our philosophy is we're going to do all of our work up front." And we tell this to every single client. If we can't work together, that's okay. But we want to know it sooner rather than later. So that's why we're going to do and go after the absolute biggest issues, concerns, whatever you want to call it, right up front. And once we can get through that, again, on the lender side, we're going to be in or out of it within 3 days because once we do engage a lender, we're going to hand them everything that they need to see, including our workbook, all the spreads, all of that is getting done in those first few hours. So once we do have a lender, we're going to send it to our lender and they are going to drop everything and review it ASAP. It's not going to be days. It's going to be just hours because of our volume level. And that's really something we bring to the table that not a lot of people can. We're $20, $30 million account to each of our lenders. So we get instant reviews, and we won't accept a lender term sheet if it hasn't been reviewed by the underwriter, by the head of credit, whoever has to sign off on that transaction, because they know better than to give us a term sheet and not make good on it. So that's where our 94%, if you want to know the truth, right, we drill down on the 6% that doesn't close. We want to know all of that. But like I said, my CEO, after reviewing all of our information and files, came back and said, you have a 94% closure rate once you're in a deal. And the reason we do that is to not only not waste time, we don't want to waste anyone's money. We don't want to waste the sellers. Nothing makes me crazier when they sign an LOI that takes the business off the market for 3 months when no one even knows if the borrower can secure financing. Now everyone's on hold for 3 months. And if you can never secure financing, well, they just took 3 months of their marketing abilities away from the seller. And I don't want to see that happen. That's really where it comes from.
Very nice. So your model is essentially do the work up front, send it to one of your lenders that you've vetted and have a relationship with, and then leverage your relationship to get better service, faster answers. And that lender, who's typically a BDO that you're working with, right? Their assignment is to provide a vetted term sheet on the deal that you expect for them to follow through on. So when you're choosing those lenders to be a part of that critical process, like, why do you choose to work with some versus others?
Well, great question. And we only keep a portfolio of 6. We have
Okay.
we have a list of lenders that would like to do business with us, but we keep 6. And that
Interesting.
is because we need our volume level to be high and we need to matter to them. We have an interview sheet that we go through with each of our lenders to make sure we're on the same page. Ultimately, and I'm happy to share a lot of that information. One is, do they sell our portfolio, their loans? Now typically after 30 years, it's going to be more who's your head of credit, who are your underwriters, because I know the majority of the people that are in our industry. And if I don't know them, then we're going to do homework on them long before we agree to work with any type of lender. But not typically, yeah, the name has changed, as you know, many times over the years, but the BDOs, the head of credits, they've been my friends for 15, 20 plus years, and if they do move, sometimes they'll call me and say, don't send anything yet. Give me a year to let this dust settle. But when they call me, they're ready to do volume, and that's what matters. We just added a new one to our portfolio that kind of fell off for almost 2 years. Head of credit popped up at a new lender, said, okay, I have fixed everything here. We're about to move forward, and we need your volume. So that's the kind of relationship we have with our lenders. They know what we can produce, and vice versa.
Well, that's interesting because that seems like a really exclusive nightclub with 6 people inside and probably a line of 150 wrapped around the building.
Thanks. Yeah, that's exactly it. And when we start telling them the criteria, most of them fall off just halfway through the interview sheet if they even want to be considered to be part of the list. But that's what we need for our clientele. We're specifically in that goodwill market. What I tell everybody is if it was a $3 million transaction with 2.8 worth of real estate, you're going to get that done anywhere. When it's 4.2 and there's a customer concentration issue and it's got to take a little bit more creativeness, that's where we specialize.
I like that you're drilling down to the people involved. That's exactly right. No one understands that, especially a borrower who's coming at this for the first time. But even 99% of loan brokers or intermediaries, advisors, whatever they want to call themselves. But how impactful is the BDO versus the bank itself in terms of delivering that borrower experience that you're looking for?
We love our BDOs. The BDO has to be the first level of knowledge. They have to be on it. It's a struggle working with a new or a younger BDO that doesn't know. We'd like somebody on our level so that we can brainstorm together as we work through transactions, especially if we're going to get creative or avenues. What we care about in the BDO, number one, is he knows his back office. That's key. What we never want to do is, and we've all heard the stories. Okay, after 3 weeks, they came back and the lender said, well, we don't do any transactions in that city. Well, you had the deal for 3 weeks, right, or a month. That's the kind of intolerance we can't have anything like that, or this industry. Well, they finally got to credit, and we don't do these industries. So there's a 1/6 coverage ratio requirement. Well, there again, it goes back to the then lack of connect between the back office. So the higher level BDO and the higher volume producers, as you know, they know more. They usually have more knowledge about the back office. They usually inform first. If they're one of the top producers, which is typically the people that we deal with, is the top producers at most of the lenders. But they're more knowledgeable and they bring something to the table.
But you could turn someone into a top producer with 20 million to 30 million of production is the fact of the matter.
We've done that. We have secured PLP for lenders. We have we counterbalance their portfolios a lot of times if they get too much into the construction end and they need single disbursement transactions. We've been called on all kinds of things like that where the lender just needed to balance his portfolio with some single disbursement loans.
What's the worst a lender has, I don't mean to be negative, but it just is an interesting question. What's the worst a lender has ever screwed up on a deal?
The worst a lender has screwed up?
Yeah.
Well, there was one just a few weeks ago that was about to hand us a commitment letter and they closed, they get sold. I I lived through the CIT days, which was, 20 something years ago. When they ran out of funds, and they walked into their conference room. So they were having a big powwow to determine which loans were going to live and which ones are going to die. And they walked in there with over 400 loans. 27 were mine. They walked out with, I think, 7 of ours. Yeah, they were doing 80% of our volume back then. And they came out with 7 and said, okay, you have 3 days on this one, you have 4 days on that one. And, so there's not a lot we haven't been through. We did have one, which was very interesting. The lender called us and said, did you know that this borrower hijacked the plane? Now we're getting off topic a little, but it's very entertaining. We didn't know because the borrower didn't disclose it, but he had done 14 years in federal prison for hijacking a plane. That was a new one on us. But there again, that was through no fault of the lender. They just happened to find it.
That's what we call a 912 issue.
Yes,
back in the day.
That is a 912 issue.
Wow. Yeah, that's crazy. So like the CIT and all that stuff, that was during the 2008 timeframe when it was, crap was hitting the fan. Have you noticed there is any sort of mini shakeup happening in the SBA world today, with everything going on with the rates and the, run on deposits last year and all like that? Have you noticed more disruption with lenders?
Well, here's what I've noticed really. 5 years ago, 4 years ago, every lender was pushing real estate. Get real estate. All real estate, which was never my market. But I have noticed that has backed way off, especially with all the mortgages coming due and all the talk about the vacant real estate around the country these days. So that's changed. So I think those lenders are ready to jump into the goodwill markets. But I think my goodwill groups are remaining the same. I don't think that's really changed a lot. It comes down to, what's the secondary market doing and where they can get their A-days from. And that fluctuates a little bit, but mortgages are pretty much dried up. And that's what took us down. If you recall, back in the 08-09 round, you couldn't find anyone to buy the secondary mortgages.
Yeah. And it's thankfully, knock on wood, the secondary market's been stable. Every week I get the notification from Raymond James and it seems to be up like a tiny bit every single week or stable or, but not going down, which is good. But last year we saw a lot of that. It went down and it was a little more volatile. But you're absolutely right. That drives a lot of it. Have you ever had a deal blow up at the closing table?
At the closing table? Probably not at the closing table. I have been called the day before closing. All right, you want to talk stories real quick? My borrower calls me up the day before closing and says, the seller is taking the refrigerator from the break room and it's on my asset list. And I'm sure you have stories like this as well. And I said, put a bow on it and help him carry it out to his car. It's a Craigslist refrigerator. But he, started spiraling about this refrigerator. So there's always stories like that. I had one where my borrowers were attorneys and they were buying a garage door company. And they called me up and they said, the seller just called us. He's not going to show up at the closing on Friday. And this was Wednesday. And I said, okay, now my borrowers are attorneys. I said, here's what you will do. You will show up at that closing and we'll all sue him if he doesn't show up. That's what's going to happen. I said, but I had to calm them off the ledge as well. But the seller did show up. We don't have too many that blow up at the closing. Usually everyone, and there again, on the borrower side, they're not in it for just, a couple $1,000 escrow. By the time the closing happens, they're in pretty deep. If they were to walk, my transaction today, he's probably into it for close to $100,000. If he walks from the closing today, that's going to be a loss. I have called the lender and asked them to blow up a closing.
Really?
I discovered fraudulent invoices. And the lender actually argued with me. We want to close.
Oh, boy.
And I said, you can't close. You must stop this deal. I know these are fake.
From the seller?
Yeah, from the seller.
Wow.
Yeah. I found that out 3 days before the closing. And I did everything to blow that transaction up. And I was able to stop it. But I found out that he had created fake invoices for the previous months.
Well, that's good for you. I mean, ethically, that's the right thing, obviously. So going
Yeah.
back to the refrigerator and the attorneys and all that. So is playing mediator / therapist part of the gig then for you?
A lot of times it is, and here's really the difference. The borrowers, and we preach this, we're on their side. We're not the broker. We're not the direct lender. We're giving them advice that benefits them. And they learn that from day one. We're the only one in the whole transaction, well, aside from the lender, that's 100% confidential. They can talk to us through anything. So, right, we're usually the voice of reason, especially if it is that first-time buyer or that less experienced, buyer. Or these days, I'm working with juniors that have come from PE firms. Because as you know, PE firms have been starving for quite a while, begging for transactions. But what we're dealing with, and this is something new on our side, learning how to screen them and figure out where their motivation is up front, because they all want to act like they're individual buyers. And then as we drill down, we found out, well, they're coming from a PE firm. Now, some have the real commitment to go and buy a business and not be, but they come to us with that PE mentality, which is a little different than Main Street. And a lot of times we have to deprogram them, especially if they get a hold of a broker and on a good transaction, and then the broker calls and says, we don't want anything to do with this guy. He's already off the chart. So a lot of times I'll have to, have a conversation with them one-on-one saying, I understand you're used to a 4-page due diligence
checklist.
You
exactly.
can't do this, Yeah. And we cross things off together, and I bring them back to reality. But, so we have lived through a few of those, but we are seeing more and more of those potential buyers that need a little bit more hand-holding or more guidance, because they don't know or understand the Main Street market.
So, Steve, any last words before we sign off today?
I don't think so. I think it's incredibly important that this SBA program continue. It is the backbone of America. This isn't about me. It's about this industry and really raising the bar. Like I said, more and more clients need more and more of this money. We're 14 years behind. Get it out, support us, get it to anybody. I'm getting to the part where, hey, brothers, moms, dads, get anyone you can to sign my petition. Let's get some more signatures there. So when we go and hit SBA, we can show all the support. But I think that's it. Just, get the lenders on board, higher ups, and let's just keep moving forward.
All right. Godspeed. Thank you, Steve, for everything you're doing. And we'll leave a link to the petition in the show notes, as well as your website or contact info, or however you want people to get in touch with you. And I'll see you around, I'm sure.
Great. Sounds good, Ray. Thanks for doing this. I appreciate you getting the message out.
All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of the Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.